Hi, everyone, and welcome to the show. My name is Jim Evans, founder of Gannon Security Partners. And what we wanted to do is we wanted to kind of reach back into the archives. We were looking at the YouTube channel that we had created several years ago. That channel was really dedicated to going over advanced planning strategies in estate and wealth transfer, and also talking about the financial vehicles that could help you accomplish those goals. And so we went through those and talked about the advantages and disadvantages of each one, and how that they could fit into a financial plan to meet your personal financial objectives. Whether that was estate planning, gifting, asset protection, we went through a lot of different things. And what we want to do here is a little bit different format in that we want to create a 20-25 minute daily episode that you can use to kind of have a good handle on what's going on in the markets today, what's going on financially, economically, what are the big topics, what are the things that the experts are talking about, and then how that might affect you. So let's bridge that gap from what's currently happening in the world, and then how that could or may affect you and your financial plan for you, your business, and your family. Lastly, we're going to wrap up every show with an estate planning conversation, and that could get into very basic understanding of estate planning from a fundamental standpoint. And then we'll build on that to talk about more advanced planning strategies, discounting, family limited partnerships, using CUPERTs, CRATs, CRUTs, all different types of strategies, advanced planning strategies for you to kind of pick and choose and say, hey, is that something that could potentially help me in my financial plan? So we want it to be educational and current, and we're going to try and use, the platform to help educate our viewers. So getting into it right away, I don't want to waste too much time. I want to get right into the economic overview, current financial news part of the show. And so obviously right now the Fed, I shouldn't say obviously, but for those of you who are kind of monitoring this and staying on top of it, you know that the Fed came out and said that they're not going to issue an interest rate hike right now, but that they're also going to keep those rates at a 22-year high at about 5.5%. And so that Fed rate is really important because it impacts banks lending to consumers and businesses. It affects some of the costs of business that go along with supply chain logistics and moving goods and services from one part of the world to the next. And so that's going to have huge implications. But we want to talk really about, with that decision, what is the Fed attempting to do? And the Fed has been very clear about saying we want to get inflation down to 2%. And whatever hardship that we have to create for the economy, we believe is almost worth it. And so what they're doing is they're continuing to raise interest rates. A year ago, you were a little over 3. Now you're at 5.5. So you can kind of see the difference between the two. And that interest rate increase or hike, as you're familiar with it being represented as, offers a lot of advanced planning implications. So there's some opportunities now because of the higher interest rates, and then there's some disadvantages that may make some strategies less attractive because of the high interest rates. So when we talk about inflation, what is inflation? What does that mean? Essentially, you have two things that are happening right now. You have interest rates that are going up, and that's to combat the inflation. But you also have a lot of things happening in the world right now that are increasing inflation. And one of those big things that people aren't talking about is wage increases. There has been a lot of wage increases from 2019 to 2023. So if you look at pre-pandemic wages versus now, wages have obviously gone up. Workers are obviously striving to push for more money into their pockets for doing their goods and services for their companies or their prospective employers. And so that is having an effect on what people can afford. And as wages go up, that becomes a cost of the business, and then that cost of the business then gets transferred to the customer, and now we're seeing a furtherance of inflation because the cost of that goods and services are going up because the wages are going up. So wages going up are normally a very good thing. We look to see that obviously in our economy. It shows health in our economy. But in this current environment, there's a little bit of a caveat there to seeing how much of that benefit we're really getting. So moving into the estate planning side of this conversation, we want to talk a little bit about what's happening at the end of 2023, moving into 2024. And there is a sunset on the horizon that we need to be aware of, and that starts in 2026. So between 2024 and 2025, we're going to see those estate planning lifetime gift exemptions, lifetime amounts, federal lifetime exemption amounts is what I'm talking about from the gifting perspective. And what that's going to do is that's going to remain high. Right now it's 12.92 million per person. That's giving you a little bit over 25 million in marital, if you're married, in marital assets that your estate can be worth, and you would have no federal estate tax burden. So essentially, you can have up to $25 million, die in 2023, and you would have no federal estate tax burden. Now, the federal estate tax is 40% over and above that amount. So depending on what your estate value is, again, a lot of people don't have to worry about this. And that's a good thing in some ways, and a slight downside to the economy in other ways. And we can get to that in further episodes as we get into those more advanced planning strategies. But talking about the estate planning federal exemption amount, the 12.92, the over $25 million for that is going to rise with inflation. So every year that tends to go up. And so we're expecting that number to be a little over 27 million for a married couple, over 13 million for a single person that they could pass away with in the year of 2024 and have no federal estate tax burden. Now, that will increase again in 2025, but in 2026, there is the sunsetting. So when former President Donald Trump changed these estate tax laws in 2017 and increased the exemption to an astronomical amount, quite frankly, he sunset that provision for January 1st of 2026, meaning it would revert back to the 5 million that it was previously per person, and then they would adjust it for inflation. So the trust estate attorneys and the experts that Gannon Security Partners and myself are in contact with are thinking that's going to be somewhere around 6 million per person. So that's going to drop it to about 12 million for a married couple in 2026. Now, again, anything can happen in between those time periods, but knowing that that is going to happen, if you have an estate that is somewhere between the size of 10 and 25 million, that becomes an estate planning opportunity for you. And you can take a look at maybe doing some gifting strategies, potentially looking at some discounting of that gifting. Maybe you can retain some of that interest when you make that gift. And we can talk in more depth about those gifting strategies and getting some of those assets outside of your estate. One of the questions that we get quite a bit in working with our clients is, well, what asset should I choose? What are the best assets to gift into an irrevocable trust, for instance? Irrevocable trust is a trust that actually owns that asset now. It would have its own tax identification number. The trustee would be responsible for paying any income taxes, capital gains taxes, anything that happens inside of that trust is the tax burden of that trust. That asset is completely owned by that trust. Differently, contrasting, is the revocable trust. And the revocable trust is a trust that is used for privacy purposes. It can own the asset. However, even though it owns the asset is still controlled, and all of the liabilities from that asset are still the responsibility of the grantor, the individual who owned that asset and gifted it to the trust. So there's a little bit difference in how we use those trusts. Both are very, very useful types of trusts. And then both are just the tip of the iceberg. Each one, especially on the irrevocable side, has a number of different types of trusts that are kind of boilerplate, templated types of trusts that are there to form certain types of things, and then what your attorney would do is kind of manipulate some of that language in there to tailor it to whatever your objectives and your assets deem as appropriate. So let's getting back to our gifting to the irrevocable trust. We would then take that asset, depending on which one we would choose. So in working with our example of gifting a asset to an irrevocable trust, let's use an example of you purchased a blank lot of land, and you purchased it because you're planning on developing it. In the two different scenarios of your options here, you could gift that asset to the trust first and then develop it. And then the gift that you made of that asset is whatever the value of the asset was with no structure on it. So potentially, let's say you bought the land for $300,000. So now you can gift that land to the trust for and you get you use $300,000 of your lifetime exemption. And so now you've gotten that asset outside of your estate and it's in the trust. And now you develop it. So now you gift the assets to the trust that you were going to spend to do that. You could do a loan arrangement with the trust where they could pay it back over time. There's a lot of different ways that you could structure that gifting or that transfer of those funds to develop that land. My point being is once that land is now developed and there's a structure on that land, the value of that land is much higher. And so you got the value, let's say it's worth $1 million once you put the building on it. And so now you have $1 million asset that's outside of your estate that you only took $300,000 of your lifetime gift exemption to get that $1 million asset out. Whereas conversely, if you decided that you were going to develop the land first, then you would have to gift $1 million out of your estate to get that asset into the irrevocable trust. And so now you've used $1 million rather than $300,000. So that's an example of a particular asset where it would make a lot of sense to gift it earlier rather than later. That would be the same exact scenario if potentially you purchased a house or any type of primary or vacation home. It doesn't really matter. It could be a commercial building and you purchase it. If you see over time that that asset is going to be highly appreciating because of the area, the economics around the area, the developments, the comps, maybe there's another building or business that's being built close to that that's going to increase the value. If you see that, obviously getting that gift out of your estate and allowing that appreciation to occur outside of your estate is very beneficial than allowing that appreciation to occur inside of your estate. Highly valued asset, large asset value. And now you're going to take all of that and try and gift it away. Now you're going to have to do that in segments, and we'll have to do that a little bit differently. Not that it can't be done, but again, in this instance, if you have the knowledge and the training, for so to speak, in advance, then it allows opportunities for you to look at assets and say, okay, if that's a highly appreciating asset, maybe I want to get that out of my estate. That's not the only assets that you might want to get out of your estate are highly appreciating. There's a number of different reasons. But that's one of the things that we were going to talk about today so that we could get a little bit of a estate planning segment going. So that's kind of how I deem these episodes to move forward. Maybe we can add some visuals to kind of help explain some of those things. And again, today's estate planning thing was a very foundational, fundamental, rudimentary topic that only really affects a small percentage of the population right now. There are, again, very few people that have to worry about their federal estate tax. One of the things that we did not talk about is depending on what state you live in, there could be a state estate tax, or there could be a state inheritance tax, or there could be no death taxes whatsoever in that state. So knowing where you live and understanding the estate tax laws in that state are fundamentally important. And that's for a number of different reasons, especially if you live in New York. There's a cliff tax, which means you have an exemption amount of a little over $5 million that you can die with or gift during your lifetime and pay no state estate tax. However, if the value of your total estate exceeds that amount by over 5%, so 105% of the current exemption, then the entire estate gets pulled in and taxed. And so, depending on where you live, the federal estate tax may be the least of your concerns. However, that may not necessarily mean that you don't have to do some state estate planning. And then lastly, taxes are not the only reason to do estate planning. In fact, a lot of times taxes, I tell people, are the smallest reason to do estate planning or asset protection or gifting strategies. A lot of times that comes in, that just becomes part of the objective of the family to pass that asset on in the most efficient, effective way, mitigating that from potential risk of life. When I say risk of life, we're all running around doing errands. We have children, we have grandchildren. We have birthday parties, we have functions that we have to do. We're driving around, cell phones in our hand. There's a lot of distractions in this world, and any accident can happen. And unfortunately, even the best people make mistakes, and they make big mistakes. And so the potential to get in an accident and have some of these assets be, brought in as potential ways for somebody to recover financial damages based on an accident or another event occurrence that happened. Anybody is just as liable to have that happen as anyone else. And so there is some real truth in planning here to make sure that you're protected and that those assets that you've worked so hard to accumulate over your lifetime remain in your control and remain in your family, hopefully for multiple generations. So those are kind of some of the things that we want to talk about. Thank you so much for spending some time with us. We are a little bit under the 20-minute mark, which makes sense and gives you a lot to tune into and understand about the current events. And if you have estate planning questions or topics that you would love for us to dive into, send us an email. Jim@GannonWSP.com is my own email. You can send that to me. You can give me a list of requirements or a scenario, and I would be more than happy to break that down for you, because I think it'll help not only you, but it'll help all of our other viewers and listeners regarding their own estate planning. And there's a lot that you can learn from other people. And if you do that, then I will just not use any personal information, any addresses. I'll just use estate values, asset values, what state you're currently living in. And I'll go through kind of some of the talking points that I think would be something that you should focus on, or at least consider to kind of reduce potential hardships down the road or concerns, and make sure that some of those financial objectives become a reality. So thank you so much for your time. Again, my name is Jim Evans. You can reach me at Jim@GannonWSP.com, and you can also find out more information on our YouTube channel and at our website, GannonWSP.com. Thanks so much.